Well, hope you're having a good morning so far. There are lots of cues to deal with this morning. So without wasting any time, let's get our entire research team in. Rima joins in first up to tell us about TCS's numbers. Rima, it wasn't as bad as what the market was fearing?
Absolutely. In fact, the revenue was better than what the street was anticipating. Dollar revenue growth 2.9%. Constant currency revenue growth 2.2%, ahead of street expectations. Margins and profits came in slightly lower. Margins improved by 50 basis points. The street was anticipating about a 70-80 basis points margin improvement, and the miss in the profits was on account of the lower other income. But even as the Q3 margins missed the mark, the company's guidance on margins is positive. They maintain that by Q4 FY23, the margins will improve to 25%, which basically means in Q4 we are likely to see the quarter-on-quarter margin improvement. Attrition has ticked lower after 6 consecutive quarters of an increase. And if you look at the quarterly annualized attrition, it's sharply down by 600 basis points. Also, the management indicated that even as decision-making has slowed down across certain geographies, their qualified deal pipeline has gone up. But talking about the negatives in the numbers, the deal wins, the TCV, the total contract value as it's called, is down nearly 4% on a quarter-on-quarter basis. It's within the company's guided band of $7 to $9 billion, but at $7.8 billion, it's lower on a quarter-on-quarter basis. The headcount addition, the overall employee base has declined sequentially by 2,200 employees, and over the past decade, TCS's headcount has declined only in the last 3 quarters. The problem is, while Q3 is pretty intact, there is no clarity, no visibility on what the future demand, FY24 numbers are going to look like. The management commentary was constructive on 2 vertical geographies, North America and UK, though they are pointing to rising caution in Europe, which is about 15% of their revenues. They say the deal momentum and pipeline remains robust, but calendar year 23 budgets are still uncertain, and it will take a couple of months before they get clarity on what the tech budgets are going to look like. Back to you.
All right, Rima, thanks very much. That's a comprehensive snapshot of the numbers. We'll also be in conversation with the TCS management in just a short while from now to decode the third quarter performance, the management, which you will see coming up on your screens now. So that's a conversation which follows in a bit. All right, we'll come back to TCS, but staying with the Tata Group, but Tata Motors now on the auto side. Sonia's going to tell us why. Sonia.
So I'm going with green for Tata Motors this morning. They report their quarterly JLR wholesale numbers and it's looking pretty good. So the management says that the wholesales in the third quarter have risen because the chip supply has gradually improved. The JLR wholesale numbers are up 5.7% quarter-on-quarter and 15% year-on-year, coming in at just under 80,000 units, which is very good. There's a significant increase in the production of the new Range Rover as well as the new Range Rover Sport. And there's a record order book that Tata Motors is seeing on JLR at over 215,000 units. Now, the client demand is very strong, particularly for the new Range Rover and the new Range Rover Sport as well as the Defender. If you look at the geography-wise breakup, it's North America, UK and the overseas market which are doing very well. North America has risen 17%, UK is up 13%, overseas market up 10%. China is still struggling because China was impacted by COVID, as we know, and Europe is also down 3%. We all know that there are big problems in the European markets. Now, Morgan Stanley put out a note where they said that this trajectory of Tata Motors will help them generate £400 million of free cash flow in Q3 and hence will help them achieve their free cash flow positive target. So I'm going with green over there. Okay, all right, Sonia, but you're tracking another one, Sona BLW Precision. Yes, because they've made an acquisition. They've acquired a Serbian company called Novelic. 54% stake has been acquired for 40 million euros. Now, this is a leading provider of wave radar sensors, perception solutions and full stack embedded technology. And this will allow Sona to get into the high growth sensor and software segment. Now, why is that growing fast? It's because of this entire EV space. The management, in fact, expects this segment to potentially touch $100 million in 6 to 7 years. The acquisition will be funded entirely through internal accruals, so no debt, which is positive. The transaction will be closed by Q4 of FY23. It will be EPS accretive from the first year, according to the management. And the deal values Novelic at an enterprise value of €75 million. Now, Nomura put out a note where they say that the growth opportunity is very high in this sensor segment as vehicles become electrified and autonomous. They continue to like the company's strategy of focusing on high technology products. They maintain a buy with a target price of 609. So this is going to be taken very well by the street, going with green over there.
All right, so that's autos in focus. Well, let's talk about Lupin now. Ekta is standing by with why we're talking about Lupin. Ekta, hi, morning.
Morning. Well, Lupin is in focus because they've received the approval from the Spanish government for the reimbursement of Lupin's drug Namuscula, which is basically in Spain. Now, this is going to be commercialized with their partner in Spain, Excellitis. But this is overall positive for Lupin, possibly because this is one of the few drugs which is available for this particular neuromuscular disorder which it treats, which is extremely rare. And hence, with an insurance reimbursement in Spain, they're probably going to see more traction for the drug. So maybe we could see a positive momentum on Lupin this morning.
Okay, all right. Thanks a lot for that, Ekta. Well, let's wind this down with Vivek. Vivek, tell us about all the other stocks in the news.
That's right, quite a few stocks on the radar. First we have the IRB twins. So IRB Infra, the company has given out the December toll collections on a month-on-month basis. Up almost 6%, coming close to the 388 crore mark. On a year-on-year basis, up almost 32%. This has to be kept in mind in context that last year, that is December 2021, toll collections were suspended due to the farmers' agitation. A similar story even across IRB InvIT. Toll collections up, steady, almost 1.5% higher on a month-on-month basis. On a year-on-year basis, up 18%. Now, IRB InvIT has stopped collecting toll from December 16th of 2022, again due to a farmers' agitation. And even the base month last year, there was a period of 15 days where the company did not collect toll. Despite that, it's a steady toll rise as far as IRB Infra as well as InvIT is concerned. JSW Ispat, the operational update has come in. On a year-on-year basis, it's been quite muted, down almost 30%. JSW Ispat, as you may be aware, was earlier known as Monet Ispat. The other stock on our radar, ONGC, some positive news flow coming in there. The production, newspaper reports indicate that the production at Russia's Sakhalin-1 block will reach normalcy by March of this particular year. Now, remember, they are expecting a significant rise as far as daily production is concerned. Currently around 140,000 barrels a day. They expect it to rise to almost 200,000 barrels a day. KRBL, the company has launched a significant marketing campaign, mainly to shift consumer preferences. And lastly, keep an eye out for Tata. The CFO of the company has resigned with effect from January 31st, 2023. Some negative news flow coming in there.
Okay, thanks folks for giving us all of those stocks that are in the news. In case you missed out on them, there's a quick recap coming through. TCS, of course, post numbers, Tata Motors, Sona, BLW, Lupin, IRB Infrastructure, IRB InvIT, ONGC and KRBL are positive news flow stocks. While on the negative side, you have JSW Ispat and Tega Industries. But the one cue that we continuously track day after day is the movement in crude. Crude has been falling and now below $80 a barrel once again. Manisha Gupta is joining in for quick commentary on that. Manisha, morning.
Morning, Sonia. Thank you for that. Well, New York session is the major volatile one. Yesterday, we did see prices bounce back to $81 per barrel as well. Before we closed the session for U.S., it was back below 80, and that's exactly how Asia is trading right now as well. While there are recovery hopes from China, but you still are looking at weaker demand from China there. The markets also are looking at higher production from OPEC and allies, and Saudi Arabia cutting prices for Asia and European customers also continues to weigh onto the prices. But it is the metal sector that you should keep an eye on, because we've seen prices gain up between 2 to 3% overnight as China moves away from zero-COVID policy, as you are looking at elevated energy prices hitting smelting in Europe and Africa, and multi-year low inventories are supportive. So we are looking at multi-month highs for steel, iron ore, copper, zinc. I mean, these are the metals that gained anywhere between 1 to 3% overnight and have started Asia positive.
All right, Manisha, thanks very much for that. We'll take a quick commercial break here. On the other side, the promised conversation with the TCS top management to discuss the third quarter performance and the outlook going forward. Stay tuned.